Welcome to Smart Investing Market Insights on today's financialnews.com. I'm Krista Das. I have two words for you: subprime crisis. I bet you would like to know when the housing market is going to turn around. My next guest says that it's only going to get worse in 2008, and Wall Street firms have already begun to turn on each other. Mike Bernick is the Sovereign Society's senior editor and global markets analyst and editor of Market Shock Trader. Mike, welcome to the program.
Hi, Krista. Thanks for having me.
So let's get right down to business. What's really driving the subprime crisis at this stage in the game?
Well, that's a great question, Krista. Of course, that's what's had the market in its grip of fear here over the last several weeks, notwithstanding a little bit of a bounce we're getting over the last few days. But essentially, what we've seen is just a major credit crunch with the subprime mortgages defaulting at a much higher rate than people thought possible. As a matter of fact, a recent report from Royal Bank of Scotland estimates that banks may need to take as much as $100 billion in additional write-offs just before the end of the year, in the next 5 or 6 weeks. And that's on top of $47 billion worth of write-offs and asset losses that they've already taken just since September, when this crisis really started to hit the front pages. All the big banks have been affected: Citigroup, Merrill Lynch, Goldman Sachs, you name it. It's probably going to get a lot worse before it gets better, mainly because we haven't even reached the peak of mortgage resets yet. And another thing that's kind of on the radar screen that investors should pay a lot of attention to is the fact that we've had some recent accounting industry rule changes that are going to make it a lot harder for these big banks and these brokerage firms to assign these fantasy land pricing to the assets that they have on their books. In other words, they're going to be forced to come clean here pretty soon.
Now, when you talk about fantasy land pricing, I'm guessing that you're talking about level 3 pricing versus 1 and 2. Can you explain that to us? What's the difference?
Sure, I'd be glad to, Krista. Basically, the Financial Accounting Standards Board is sort of the watchdog for the accounting industry. Now, they're a little frightened with the subprime crisis because they're worried that we're going to have another Enron-like collapse because of phony accounting going on. Now, these big banks and brokerage firms, as many investors know by now, have kept a lot of these subprime assets and asset-backed securities off their balance sheets. They put them in what they call structured investment vehicles, or SIVs, you've heard a lot about recently. Now, the main reason to do that is to keep the potential liability of these loans off their own books. So up until now, they've gotten away with pretty much pricing them any way they can, very similar to Enron or WorldCom did a few years ago. You remember, Krista, those firms both went bankrupt and scared a lot of investors, lost billions of dollars. The same thing has really been going on with the nation's biggest banks and brokerage firms, and up until now, it's all been pretty much legal. But recently, the Financial Accounting Standards Board passed new regulations that they've instituted, which are going to make it much harder to price these assets just any way they feel like it. Now there's 3 different levels that the banks must adhere to, called level 1, level 2, and level 3 pricing. Now, level 1 is basic. It's basically what you call mark-to-market accounting. People are probably familiar with that term. It's the price of an asset that you see in a normal market transaction. For example, IBM. Everybody knows what IBM's price is. You just go to the New York Stock Exchange or to Bloomberg and you look it up, and whatever the price is on the exchange, that's IBM's price. That's the market-to-market value. So it's easy to value those assets. Then you get into level 2 pricing. Now, level 2 assets, this is where things start to get a little bit murky with the phony accounting. These prices are dependent on what they call inputs that are not readily observable. In other words, they're not market prices. They may be private transactions between a couple of big banks. For instance, Merrill Lynch does a private transaction of mortgage securities with Citigroup, let's say. That price is not observable for the market as a whole. It's a private deal between those 2 banks. So they can use that price to say, well, maybe this is what the value of the asset is worth. So I call it mark to maybe accounting. Maybe it's worth this much, maybe it's worth a whole lot less. We really don't know, but we're just assigning a price to it. Then there's level 3 assets. Now this is where things get really a bit hokey. In level 3 asset pricing, you're basically looking at transactions that have no market prices that are observable at all. So it's basically guesswork is what is involved. That's what I call mark to make-believe accounting, which is essentially just pure guesswork. They're putting these fantasy land prices on these assets. And that's the whole crux of what's going on with the credit crunch and why Wall Street is in the grip of so much fear right now, why investors are reluctant to really get into these financial stocks, is because these brokerage firms haven't really come clean about what these shaky level 3 assets are worth. Nobody is exactly sure how many more billions in asset write-offs they're going to have to take based on this.
Okay, so Mike, in light of this fantasy land pricing, how do the major firms on Wall Street stack up against each other?
Well, that's a great question, Krista. I mean, basically, that's what's got investors so fearful of the banks and the brokerage firms. They don't want to invest in these because they're not really sure what the value of these level 3 assets are. And we're talking about an enormous amount of assets at work here, enough, as a matter of fact, to wipe out the entire book value of some of these brokerage firms. I'll give you one example. Morgan Stanley, a leading American household name in the financial sector. Morgan carries about $88 billion worth of these level 3 assets on its balance sheet right now. That's after the write-offs it's already taken. It's still left with nearly $90 billion in assets. Now, we're not really sure what the real value of these is. Morgan's carrying them at $88 billion, but they could be worth substantially less than that. Well, that $88 billion and hard to price, who knows what the value of these assets really is, represents 250% of Morgan Stanley's book value of only $35 billion. So in other words, if they were to write off just half of these assets down to zero, say that they're not worth what they thought they were at $88 billion, they're only worth, let's say, $40 billion. That would wipe out the entire book value of Morgan Stanley, one of the nation's largest brokerage firms. And it doesn't get any better with the other Wall Street firms either. You look at Goldman Sachs. They have level 3 assets. Again, who knows what the value really is. Goldman says they're worth about 185% of their capital. Could be a lot less. Citigroup, even after taking a $10 billion write-off already, they have subprime assets worth more than 100% of book value. At Bear Stearns, it's 150%. It goes on and on. A lot of these brokerage firms, these main Wall Street banks, haven't really come clean yet with what the values are. And, Jim Grant from Grant's Interest Rate Observer, guy that's been around a long time, follows these financial sector very closely. He said that if these brokerage firms are forced to write down the value of these assets to what they're really worth, maybe zero in some cases, most of the major brokerage firms on Wall Street could actually end up going broke. Now, they may not have to write the assets down quite that far, but we're already seeing evidence that some of these subprime mortgages are trading at 20, 30 cents on the dollar, with what they're being valued at. So we're looking at some major hits that are still yet to come here in the industry.
So let's talk about Freddie Mac for a moment, since it appears to be the bellwether in this storm. Within the past few weeks, Freddie Mac, which is the second largest mortgage financing company in the U.S., reported a $2 billion loss due to the subprime crisis. And just last week, it was reported that the company might need to raise about $6 billion to get out of this mess. What's the deal here?
Well, Freddie Mac is a good point. Freddie Mac and Fannie Mae are what they call government-sponsored entities that are essentially chartered by Congress to essentially stabilize the mortgage market. Their whole reason for existence is to buy up mortgages in the secondary market, providing liquidity, and at the same time to guarantee mortgages that are out there. Now, the problem is these guys are such big bellwethers in the industry. Their charter, again, is to stabilize the mortgage market. Instead of that, these guys are victims of the credit crunch just like the big banks are. They've got too many of these subprime loans on their books that are defaulting at record numbers. That's why we saw the $2 billion charge this quarter, as you mentioned, from Freddie Mac. And it's probably going to get worse for them as well. They've already announced that they're probably going to end up with about $500 million worth of subprime mortgage-related losses this year in 2007. Now, their own estimates, Krista, say that they could have up to $1.5 billion in 2008. So that's basically tripling the number of losses they've had this year. Then in 2009, they're forecasting $2 billion worth of losses. So this is what I said at the top of our interview, that this problem is by no means over. In fact, we're really just at the tip of the iceberg. Freddie Mac itself is talking about a tripling of loan losses next year in 2008, and then a quadrupling in 2009. And their projections, their own internal projections, when they come up with these loss numbers, are assuming that housing prices fall only 5% from peak to trough. Now, just yesterday they reported the September numbers, the most recent data we have on housing nationwide, shows that prices are already down 5.5% from their peak a year ago. So, we're already lower now, before the end of 2007, than Freddie Mac is even assuming for the next 2 years. I've seen some private sector estimates that housing prices may fall 10, 12, maybe even 15% peak to trough before this is over. So, that would result in trillions of more losses for Freddie Mac and for Fannie Mae, and obviously for a lot of the big Wall Street banks and brokerage firms as well.
Mike, great information. Unfortunately, we're out of time. Thanks for being on the program.
Thanks for having me.
Well, that's all for this week's Market Insights. If you would like more guidance on the housing market, you can do so by clicking on the screen or go directly to todaysfinancialnews.com. Thank you for tuning in. Until next time, here's to great profits from smart investing.